Hello, this is Simon Thompson, Vice President and Wealth Advisor at Texas Legacy Wealth Management. Welcome to our monthly market update for September 2015. We're going to walk through the major market events of the month. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Texas Legacy Wealth Management, a registered investment advisor and separate entity from LPL Financial. After experiencing a rough month in August, September's stock market returns gave investors little to cheer as volatility continued. The S&P 500 dropped another 2.5% in September, which left the market down approximately 7% for the quarter and resulted in the worst quarter for the S&P 500 since 2011. From peak to trough of the recent correction, we've seen the market drop about 12.5%. The question that we and many others are now trying to answer is whether we're seeing a normal correction, albeit unpleasant, period of volatility, or if this is the start of something much worse. Concerns continue to focus on growth and central banks within the U.S. and around the world. Once again, China was at the forefront of economic news during September, coinciding with Chinese President Xi Jinping's visit to the U.S. Weak data coming out of China has many market participants wondering what's happening to the world's second largest economy. The lack of transparency in Chinese data adds an additional challenge in getting a clear read on the economic environment. The rate of growth in China's economy will continue to be a hot topic as we enter the fourth quarter of the year. The concern over China reached the Federal Reserve as Janet Yellen announced that there would be no increase in rates at the September meeting and cited concerns over global economic growth as a key reason for caution in raising rates. The Fed's statement, press conference, and subsequent Fed speakers have done little to provide certainty in the time frame for the first rate hike. While the Fed has indicated they're still likely to raise rates at some point in 2015, any weak economic data in the U.S. will potentially push the timeline further back. As mentioned earlier, the question we need to answer is whether or not we're in the midst of a bull market correction or if we're seeing the start of a longer-term bear market. In trying to answer this question, we turn to our economic dashboard, which provides guidance as to the strength of the economy. While the economy isn't the same as the stock market, it does provide a roadmap. Per LPL Financial's annual outlook for 2015, when the economy has not been in recession, the S&P 500 has been positive 82% of the time and provided low double-digit returns. When the economy has been in recession, the S&P 500 has been positive just 50% of the time, with average returns in the low single digits. So what does the dashboard say now? Right now, we see signs of an economy that may be set to continue on the path of slow, steady growth. That being said, we remain vigilant as some of the most recent economic data points have disappointed, including PMI and the September jobs number. If our outlook for the market was to change, we would likely make changes within portfolios as our philosophy is not one of buy and hold. If we feel the level of risk in the market warrants it, we have the ability to position portfolios more defensively. We're not currently defensive, as the current environment is one that we feel is more likely a correction than the beginning of a bear market. As uncertainty surrounding the markets and economy persists, we would not be surprised to see volatility continue. If you have uncertainty or have felt uncomfortable during the recent volatility, now is a great time to review your overall asset allocation and make sure your portfolio is built with consideration for these types of periods. For more information about Texas Legacy Wealth Management, you can contact us via phone, email, or feel free to visit our website. We would also like to remind you to follow us on Twitter and like us on Facebook. Thank you.